All right. So the question is, how is it that why do companies do bad things, right? What makes a company do bad things? Does anybody? Yeah, have a seat. Just relax.
Okay.
So before, okay. All right. So who's got some answers? Like, who's ever thought about what companies do bad things?
Stupidity.
Stupidity. That's a good one. Yeah.
Money.
What about money?
They'll do, I guess, maybe we might think of as unethical
To
get some profit.
make more profits. They're stupid. They want more profits.
Corporate greed.
Greed. They're greedy. Not just some money, but all the money. Anything else? Some people think that there's a kind of selection bias, so that evil people end up being CEOs. That there's a kind of psychosis that goes with being a CEO. So we started to think about why it was that companies got kind of trapped in being evil. And we wrote this article on the overvaluation of companies. Now, does anybody have any idea about the stock market? Does anybody ever, like, do you know anything about this stuff?
TFSA.
Pardon me?
TFSA.
Tax-free savings accounts?
Yeah.
So some people have money they've invested in the stock market and it's held in a TFSA. But the stock market is essentially a way that anybody can buy a little tiny piece of a company. And there's a lot of theorizing about companies and stocks, but the idea is that the stock market is a kind of group mind, a hive mind, that figures out what a company is truly worth, right? So when you buy a stock in a company and it costs $10 and there's 100 million shares outstanding, that says the company is worth $1 billion, right? So you want people not to get ripped off. You want the price of each share to fairly represent that portion, that little fraction of the company that it represents. So far, so good?
Yeah.
Okay. So I'm going to be basing a lot of what I say on that little kind of frame of reference. So the thing about companies doing evil things, what we realize is that it's not all kinds of companies that do evil things. We're not used to, like, the people at the corner store being evil, right? They might, from time to time, sell milk that's gone past its date, or they don't tend to be evil. So when we think about inventors and entrepreneurs, does anybody know any entrepreneurs, anybody that started their own business? Anybody? Yeah? And what's that person doing?
Working 24/7.
24/7? What are they making or building or doing?
Between, like, I know people in restaurant business that build companies and multiple restaurants, or paper business trading.
And what are they trying to accomplish? Are they, like, what's their motivation? Is it
Sell, I guess.
to sell? Okay, so they want to make some
Grow
profit.
a business.
Grow a business, and they're actually trying to meet a need. Usually when companies start out, they're trying to meet a human need. They have some gadget they think is helpful, or they have some service they think is going to make things better, right? So entrepreneurs generally are seen as almost altruistic. They'll get a profit if they work hard enough, but they're not seen as evil. And we also don't see, as I said, the people that run small businesses, they don't tend to be seen as very, very evil. If you own a family business, you're just trying to keep things going for your family and the next generation. So what happens when we get to great big old companies? Right? That's where we see some of the evil, some of the most evil behavior. So what we noticed was that many of these CEOs, these head guys, are locked into crazy behaviors. So this is a quote from the guy who was the CEO of Citigroup, the big New York bank, right before the market crashed. Right? This is 2007, 2008, everything goes south, right? He says, when the music stops in terms of liquidity, that means enough money to cover their bills, things will be complicated. But as long as the music is playing, you've got to get up and dance. We're still dancing. So he knew that there were crazy things going on in the banking system. He knew that eventually there would not be enough money to cover all of the loans that were going to come due, that the bank wouldn't be able to cover those payments. But he kept moving the money around as long as he could so that the profits would come in, the stock would stay up, and everybody would think things were fine. So these are kind of the same questions, like why did the banks do that? Well, why do oil companies who have known, has anybody followed the Exxon New hashtag? You know that one? Exxon New? K-N-E-W, not N-E-W, Exxon New? Do you know what Exxon knew and when they knew it? Anybody know? Exxon knew in the 1970s that they were creating global warming. And they worked on a little more science after the first data started coming in that indicated that that was happening, and then they shut it down, and then they made sure that no one in the world was paying any attention to it. So there's been a hashtag on Twitter for a while now, Exxon Knew. Exxon knew, and they hid it not just from you and me, they hid it from governments, from regulators, and they also hid it from their investors. Now, if you had stock in Exxon in 1975, and in 1976, Exxon had told you that they were causing global warming by extracting all this oil, what might you think? What would you do if you had stock in a company and it suddenly said, hey, wait a minute, we're causing some catastrophic things to happen?
Sell it?
You might sell it, right? The price might dip, right? But they lied. They lied for a long time. So we said, that's kind of weird. Why didn't they change what they were doing and start exploring renewables back in the 70s? Why didn't they make a business decision that that was a bad idea and they had better ideas? Why do companies like Monsanto, when they find out that one of their chemicals will cause extinctions, like neonics in bees, or DDT in birds, why don't they come up with safer ways of doing things and sell those? Kind of stupid, right? Who was it that said stupidity? Was it you? Yeah. So it's a real question. Why can't they let go of what they're doing that's wrong and pick up something new and different? And for you folks that are in health studies, why right now are we in a situation where the soft drink manufacturers cannot get it through their heads that it's a bad idea to sell sugar water? Yeah?
They're making money.
They're making money,
They don't care.
but couldn't they sell something else and make money doing that?
I suppose, yeah.
So that was so puzzling to me.
Excuse me. Both Pepsi and Coke have for quite a long time gone into alternatives, including water and orange juice,
Uh-huh.
right?
Ooh, that,
This is my new cup that doesn't work. Oh, well, that was a great idea. That's the trial night of my new cup. So they're trying to market those.
They have been for years.
Yes,
Okay.
and unsuccessfully and without a
No,
lot of...
not unsuccessfully. It's a big part of their products.
increasing, but most of their revenues are from colas, right? So they're
I
trying,
think so, yeah.
but not wholeheartedly. So, in fact, there's a story about the CEO of Pepsi who said, we've got to get out of the sugar business. And her board said, no, you're making money, you have to stay in it.
I would just say that, I mean, I actually agree, I think they are trying, but I mean, in the case of orange juice, actually, orange juice has probably as much, if not more.
Or sugar.
Than cola, so
Uh-huh.
it's not really a good alternative.
So they're kind of worried. They're quite up against the wall with increasing sugar regulations that they could have anticipated. They could have, in fact, moved their market share out of those drinks and haven't been. So why do companies keep selling and defending dangerous products? So is it good for the company to keep selling that stuff? Well, our contention was, in fact, it's not good for the company to sell that stuff. In the long run, the company is worth far less when CEOs do these highly risky strategies of trying to maintain a market in dangerous goods. But it's bad for the company. So when things might have a differential impact on the CEO and on the organization, what you have there is called a principal agent problem. The head of a company is hired help, right? He's not or she is not the owner. They might have some shares, but they are not. They are hired by the board, which acts for the owners. So this issue of how do you trust somebody with a large corporation started to come up in the 1930s. And people wrote a lot about that problem as companies emerged from, emerged into consumer goods and out of just having railroads and steel as big companies. There are many more big companies emerging in the 1930s. So these guys named Barrell and Means wrote a lot of stuff that was very powerful in business writing for a long time about the appropriate role of managers versus owners. And it's been an issue clearly for 85 years or so. Well, 80 years. 85. But it all kind of changed radically 40 years ago when a guy named Mike Jensen with somebody named Meckling wrote a paper called Agency Theory. And for those of you who are academics, you can only weep at the number of citations this thing's had. 61,107 as of this afternoon. Whoa. Probably higher than that now, right? There's probably a ticker somewhere that keeps rolling over. So they said, it's really hard for boards to know what's going on with CEOs because the CEO has all the information. The CEO's there every day. The board flies in 3 or 4 times a year and only gets the information that the CEO has. It's really costly and difficult for boards to be able to tell the CEO what to do. So how do you manage this principal agent problem so that the board can be assured that the CEO is doing what's in the company's interest and not in the CEO's interest? Does that make any sense? So they said it's expensive for the board, and they said there's a conflict of interest between the corporate managers and the outside equity and debt holders. Okay, we'll believe that. Well, the costs are contracting with the CEO, monitoring, and kind of bonding with the CEO. And as well, there's always going to be a kind of residual loss because the CEO doesn't always, even in the best of circumstances, it's not always going to be right. And they, Meckling and Jensen, who are the we in that last sentence, said the way to manage this is through market mechanisms. We'll figure out how to price or how to deal with things so that the managers do what the board wants, do what the owners want, right? So they invented a whole mechanism of organizing the company and published it in 1983 with Eugene Fama, which also has a lot of citations, but not 61,000, maybe 30,000. Fama and Jensen say, okay, we can organize the whole corporation around this new idea. So now, since Fama and Jensen, companies don't pay big salaries. So when you look at how much a CEO makes, the salary is a small portion of what they take away in a year. Most of what they take away is a bonus, right? And the bonus depends on the price of the stock and how much it's gone up that year. So CEOs are supposed to take good care of the company by raising the stock price every year. And once again, we remember that this assumes that the stock market is all-knowing and all-seeing and can price these shares appropriately. Well, it didn't take CEOs very long to figure out that that's a very easy game to play. They can artificially raise the price of the shares by planting rumors, by doing all kinds of things that increase the value of the company kind of temporarily or with kind of smoke and mirrors. So if the stock price is very high, the evidence for making it that high is always that the company has to be earning that much money, right? The company has to show profits that make it worth buying a very expensive stock. So what are you going to do if you're not actually making that much money? Well, they did some research and they asked CEOs what they would be willing to do to up the quarterly information the analyst reports would use to say how well the company was doing. Well, they would artificially decrease spending at the end of the quarter to show that there was more profits. So even if you needed to do the research and development, advertising, maintenance, all those things that keep an organization going, 80% of them were willing to cut that back to look good to the analysts. Even if there was a project that needed to start, they would delay it. More than 55% of people would delay it to make their quarterly report look good to the analysts. They would book revenues now rather than next week if they had a choice. Anybody here ever worked in retail? Okay. Do you ever get incentives to sell a certain amount this week or this month? Okay. Now my students have figured out ways to get their friends to come in and buy to get them up to that level and then return it next week. Yeah, right? So that's called stuffing the pipeline. And people do that, you know, when they work for the Gap or whatever. But they also do that when they're the CEO of companies on a much larger scale, right? So there's all kinds of ways that these CEOs manipulate the stock price at the quarter, right? 4 times a year. And they sometimes draw down reserves. They do terrible things, right? Just to kind of make it look good at the end of the quarter. Well, when a CEO leaves, what happens to the stock price? All of a sudden, nobody's doing that kind of whispering And what happens? Well, you could guess, right? Drops a lot. Well, nobody's too surprised because it does that with every company. And then the next CEO comes and is really happy to have a low share price so that he can whisper it up too, right? So when you've got this going on, at Citigroup, here we are, Citigroup managed to get their stock price over $500. Bye. Is it something I said? And then when the banks started collapsing, it went as low as 10, and it's never gotten above 60.
Wow.
And that was all whispering. There was no real value in Citigroup, right? And some of that was, what's the name of that one movie that came out last Christmas about the
Big Short.
Big Short? Anybody see that movie? Good movie. That you see that here. Those houses weren't worth anything, and that they did that on every kind of level. Companies, houses, all kinds of deals. Also happens in pharmaceuticals. So how do pharmaceutical companies make money?
Markups, drugs,
Pardon me?
drug markups.
So first they have to come up with a drug that does what? Like if you were the Federal Drug Administration USA, or you're the Ontario Drug Formulary in Canada, or wherever, what does the drug have to do?
Safe and effective.
Safe and effective. It has to not kill people, and it actually has to help people, right? Straightforward. So how do you get those drugs? Well, for many, many, many years, the answer has been you hire smart scientists and they go and figure things out, right? Now we sometimes have pharmaceutical companies buying little startups in biotech pharma, and so they can either hire the scientists or they can buy their little companies. But they put lots of money into R&D. And so over the years, they have put tons and tons of money into new drugs. So this is the line. This is 2010 normalized dollars. That means what's a natural log there? 2e to the 10th. Okay. So we see it's fairly consistent. There's a peak there. I don't know what that is, but it doesn't, it kind of goes away. Valley there, it goes away. They spend a lot of money on R&D, right? For a long time, oh no, sorry, got it backwards. Here's the R&D. So they spend a lot of money, but then it goes way up in 2004, and they spend way more money. 2004, they're spending more money because they had this dip in number of drugs. I keep losing more and more of them.
Don't
No,
take
I'm
it personally. I don't know what it means.
All right, so their R&D, they put it way up because they saw the number of drugs approved going down, and look, it didn't go up, right? There's 1 year here we get some more, but they keep pumping money in and nothing happens, right? So they start doing crazy things. What are they doing now to make money? What are pharmaceuticals doing now to make money?
Raise prices.
They do terrible things around pricing, right? So we've heard about EpiPens, right? There's a big thing that just came out in the New York Times yesterday about GlaxoSmithKline bribing the Chinese government and getting nailed for it. They've got $500 million worth of fine, and some of their execs have spent 2 years in jail in China. It's harder and harder and harder to make money as a pharmaceutical company because the R&D you're doing doesn't turn into approved drugs. So they squeeze more and more money out of old drugs and do it in ways that could kill people, right? Why are they doing it? Because the share price is overvalued. and the CEO wants to keep it there, right? So Bernie Sanders tweeted this week about some diabetes drug, and the share price fell 1% right after he tweeted that the diabetes drug price was too high. Right? There's a really close relation. It's still since regained that 1%, but they panicked, right? Because when you go after a drug company, sometimes they have to cut back their prices because it's so obviously hideous. So yes, the price of Lilly dropped. And right now, the one that's most obvious to most of us is oil and gas. Right? So, do people know the concept of stranded assets? Ever heard of stranded assets? Tim has? Okay, so it turns out that if we want to comply with the Paris Agreement that we've signed, that's now coming into effect, tomorrow? We cannot explore any more or develop any more stuff in the province of Alberta. All those tar sands, it's over. So many companies have tar sand assets on their books. But if we don't want to cook, those things have to stay in the ground. So it's called unburnable carbon. And if it's part of your corporate assets, it has to stay in the ground. How much is it worth to you in the ground?
Not much.
About zero, right? So many of these companies are really scared. So what do they do when their biggest asset is now unburnable carbon, when it's stranded? Well, Exxon for 40 years tried to avoid this, right, by lying. Exxon knew. The other problem is not just Paris, but we've now started to see, and Shell has just come out with a statement saying that they see peak oil consumption happening maybe as soon as 5 years from now.
Is it related to the peak oil theory or?
Peak oil consumption, not peak oil development, but peak oil consumption. That we are turning a corner. We've already hit peak coal, but we will soon be hitting peak oil. Right? So that means less and less consumption, it's worth less and less. As well, what's happened to the price of oil in the last 2 years?
Plummeted.
Pardon me?
It plummeted.
Plummeted. It's gone from like 150 a barrel to 50 a barrel, right? So it's a problem because all these companies need the profits from those barrels of oil to support the share price, right? The share price is always a multiple of the profits. 17 times or 10 times or 20 times, something like that. And if your profits go to zero, your share price should be going to zero. They should kind of follow each other. So the CEOs who are paid on the basis of their share price are terrified. So here's another reason that they're terrified, and this is a graph that came out from Bernstein Research, which is a big business analysis shop, in 2013, and it's still true. This is the price of Henry Hub gas. This is the price of bituminous coal per million BTUs. This is the price of liquid natural gas. This is just, no, that's Brent, and this is natural gas. And here's the price of solar. Whew. Now that's 2012. It would be like here. It's well below everything else now. So if you have to sell these things that that are politically problematic and more expensive, what are you thinking about your profits? You're terrified, right? So they will do whatever it takes to make sure that their assets are not devalued. And you can see, this graph I just did in Excel, and I sent it to Harvard Business Review, and it was too radical, they couldn't print it, but you can see it here tonight. So this blue stuff is an index, which is a kind of compilation of the worth of all of the US oil and gas stocks. Okay, the Dow Jones has an index of oil and gas stocks. So it starts here and it's a little unreliable, but let's say it here we go. All this blue stuff is the value of the oil and gas companies in the US. And it tracks almost completely the price of West Texas Intermediate oil. Right? It's really tight until we get here. And then they decouple. And here we are at a $45 price, and just way higher market cap for these companies.
I apologize, I'm just going to go. Thank you.
You finished your candy and now it's time to
No,
go.
I really enjoyed the talk. It was really interesting. I guess I have to go.
Okay. So here we are, showing you that it is overpriced, that the value of these companies is way less than what they say it is. And as the consumption goes down and as the price stays down in this oil, it will be.
What's the year where you see the departure of the two prices? Is that
Right here, 2012.
2012, okay.
I would love to know what happened there that made them realize, like I'm going to have to find the analyst's phone calls in here to figure out what made people keep the prices up, even though this, which should be an indicator of how much the company's really worth, and was for a long time, departs from that. Like, why isn't the company worth this now? Rather than this.
Actually, an idea is that the price of oil is one thing, but the volume, right? The volume usually increases, not lately, right? But
and I completely believe you, but they tracked completely for this whole
Yeah.
long section, right? So you would think that they would continue. And I think that the variance down here is because this was a brand new index, right? And they were just kind of figuring it out. So yes, they're selling a little bit more oil than they did, but now Shell's seeing that volume is peaking. It's coming down.
And in terms of 2014 until now, I mean, I think, and this is my opinion, and I think many people agree, it's very much political with price of oil due to Saudi Arabia playing some games, right? So that's not necessarily an intrinsic price or value of oil, but it's viewed as political.
Well, Saudi Arabia, I think, figured out that we weren't going to be able to burn all the oil. They were the first, and there's in fact articles out there that suggest that the Saudis figured out that most of the oil that people had on their balance sheets that was called assets would be stranded. And they knew they wanted to be the ones that were selling the oil and everybody else could go to hell. So they dropped the price of their oil and said, we're not going to try to keep the price supports up, we're going to drop our price, and then everybody, like if we sell it at $40 or $45, it only costs us like $20 to produce, we're still making money. But in Canada, it costs them $75 a barrel to produce, so they won't be able to produce, we'll be able to starve the Canadians out, right?
Yeah, that's true. Actually, one last point I think I remember just now, even though the price of oil dropped like 1/3 or 1/2, but at the pump we're still paying whatever we were paying like 2 years ago.
A little less.
A little, just marginally less. And I think
Right.
the companies, that's where they
Right.
balance it somewhat. But
When there's other fees and
unfortunately-
stuff, taxes and stuff.
Unfortunately, yeah.
But what we're seeing here is that the companies have been able to maintain a sense that they're still valuable in spite of all the evidence, right? And they're sticking with their product, and they're propping it up. And in fact, they're making choices to develop new oil fields that are expensive and bad for the oil company itself. They're only going to lose money on those investments, right? So at the end of the day, it's not just bad for the environment. It's not just bad for shareholders. It's bad in the long term for the company. The company will be losing money on all these crazy things that they're doing to prop up the price. Yes,
What's
sir.
the Henry Hub gas? That sounds so exotic. I gotta know what that is.
Stuff that's pumped through a hub called Henry.
Oh, really?
Yeah, there's all kinds of weird metrics out there. If you go to a website called Fred,
Oh, yeah?
it's called Fred,
Oh, yeah?
kind of sounds friendly. It's the St. Louis Federal Reserve Bank,
Oh, yeah?
has a giant economic database that's completely free and open. And you can get all kinds of data from them. So my favorite acronym is FRED, but Henry is good. There's something like the Baltic shipping rates. Everything has nice names. Enjoy it. Go look at Fred.
So
You'll
there's
enjoy
somebody
it.
called Henry who has a...
I don't think it's Henry.
That's
There's a guy
good.
named Henry. I don't know what Henry is. But they all have interesting names.
Oh, yeah.
So in fact, this week is when we're seeing some of this happen. The Exxon is looking at writing down some of its assets. It's ready to write down 20% of its assets, it looks like now. And that's remarkable, right? What happens when they write down 20% of their assets? 20% of their share price goes down, right? We're going to see that more and more. These energy companies are going to get poorer and poorer. There are going to be more and more mergers and acquisitions, big companies eating little ones. We're going to see that happening in the pharmaceutical industry. We saw that happening with the banks in 2008. So when these assets are completely overvalued, the companies that have cash are going to come along and buy them when they collapse. The question for those of us who are trying to live in the world, taking medication, trying to stay warm and move around without destroying the planet is, can they come to their senses before they've destroyed everything for us? I got my doubts. So, there we are. Questions, debate. Thank you for those of you who stayed.